Hello, and welcome to Chapter 4 in Healthcare Supervision. We are going to be talking about budgets. Yippee yay, one of my favorite things. Okay, so starting on page 67, it talks about what a budget actually is. So it's a plan that converts the organization's goals and objectives into targets for revenue and spending. So revenue is money coming in, and of course, spending is your expenses or money going out. So just like your own bank account, your revenue is your paycheck, and your expenses are the things that you have to pay for each month, whether it's rent or food or gas for your car, whatever. So we're going to try to make this as easy as possible and bring it down to where we understand it on a personal level, not just a budgeting HIM level. So let's look through our slides here. We first start out talking about some common budget types, and our first common budget type is the operating budget. The operating budget summarizes the anticipated expenses for an HIM department's routine day-to-day operations. So think about that as your own personal monthly budget. You budget money for, again, things like rent, groceries, gas, your cell phone, anything that you're going to need to pay for each month. That's going to be a line item in your budget. So it's the same way for your HIM department. They've got salaries and wages. They've got things like, okay, someone needs a new phone because their desk phone broke, or you need 2 new workstations because you're hiring 2 new employees into the department. So anything that you're going to pay for in that month's time frame, you need a line item for in your budget. So again, we're looking at the day-to-day, just routine operations. Salaries and benefits for departments' employees would be an example of an operating budget expense. So I said salaries and wages. All right, flipping over to 68. Second common type of budget is a capital budget. Now, these capital budgets detail purchases and other expenses related to departmental capital assets. So capital assets are physical things that you need. So if you're a radiology department and you need a new MRI machine or you need a new CT machine, that is a capital asset. It's usually pretty expensive. You're going to use it for more than 1 year. And a lot of times organizations have a separate process for creating capital budget requests because, again, these can be very big ticket items. All right, so let's talk about budgeting as a planning tool. We've got 2 approaches here. We have top down and we have bottom up. So let's talk about top down first. So the top down method is fairly straightforward and demands the least from a manager in terms of the time and research required to create the budget, because the top down budget is prepared by your finance department and it's just distributed to the department and put into place. So me as a department head or me as a manager in that HIM department, I don't really have any say in what goes down in a top-down budget. They hand me my budget and say, here you go, follow this. From a manager's perspective, the advantages is there's not that time-consuming, beating your head against the wall trying to get your budget just perfect, because again, it's handed to you. And there's minimal need for negotiation as the budget has already been pre-approved by senior administration. Now, the downside is that the final budget includes little, if any, input from the department. So in a top-down budget, managers are asked to implement a planning tool that they have had no part of developing. So you as an HIM professional know more about coding resources and things that your employees need than someone in another building, possibly in another department. And so again, that's definitely a disadvantage. You don't have any input in the top-down approach. Now, in the bottom-up approach, this is when managers do have input. So in the bottom-up approach, a budget is prepared at the department level with input from those who will be responsible for implementing the final product. The assumption is that those who work most closely with the budget will have the best ideas as to the wants and needs of their respective areas. Staff employees, supervisors, and assistant directors are encouraged to submit their budget needs along with justifications, and from this information, you create your department budget. Now, final approval can go back and forth because there is going to always be some negotiation because they don't want to spend money. So any single thing they think, oh, well, that's a want, not a need, they're going to come back and say, well, why do you need this? What's your justification? And can you get by without it this year? So they're going to look at chopping things off of your budget, especially in this bottom-up approach. Now, the benefit of your bottom-up, again, we've already said it, is that the people responsible for implementing the budget and following the budget and meeting the budget are the ones that actually came up with the budget and had input. So that's definitely an advantage. All right, so in the budget planning process, so in the operating budget, we talked about, again, that's your day-to-day routine items. And first sentence there says it all. Budget planning is a continual cyclical process. Both your capital and operating budgets function according to a budget cycle. So your budget cycle is usually your budget calendar, or when your budget is actually going to be in place. And this is called a fiscal year. Fiscal meaning money. So what's your money year? Now, a lot of places, again, it's a consecutive 12-month period, but not everybody's going to go January 1 to December 31st. You probably saw that in your PPE sites if you asked them what their fiscal year was. I know North Mississippi Health Services, their fiscal year is October 1 to September 30, and they follow along with the federal government, whose budget's the same. I believe our state budget here in Mississippi runs July 1st through June 30th, so it's different. So not all fiscal budgets or fiscal years are going to be January 1 through December 31. Could be any variation of 12 continuous months. Now, volume projections were over on page 69. Budget preparation research should also include a review of any volume projections that the organization may experience. Volume projections, they're basically estimates for budget calculations, and you're basically forecasting the amount of services that the organization is going to provide. So you're looking at how many admissions you're going to have. You're looking at the number of discharges. You're looking at ER visits. You're looking at outpatient surgeries. You're looking at patient days. So you're trying to make projections so that you can come up with your operating budget. Now, dropping down to capital budget planning, the unique procedures to consider when developing, or there are unique procedures to consider when developing a capital budget. Capital budget plan for the purchase of capital assets. So we talked about that. That's the physical things, property, plant, equipment items. We talked about MRI machines, CT machines. For the HIM department, it could be a scanner, because scanners are expensive. Some organizations, they put caps on capital budget items, and they may say if it costs less than $5,000, it's not a capital item, or if it costs more than $5,000, it is a capital item. So there's going to be caps there. Now, in addition to the quantifier that a capital asset has an estimated useful life of more than 1 year, organizations also attach a monetary value when defining a capital asset. Most organizations require a capital budget purchase to be in excess of $500, $100, or even $2,000. Now, again, it all depends on your organization. If your organization is small, then it may be that $500, because $600 could break the bank for a small organization. Now, the exact amount will vary by organization and is part of the budget policy. Now, there's usually stiff competition for capital budget dollars within an organization, and there's just not enough money to go around to give every department everything they want or need. That's real life. There's not enough money that they are going to allow to be spent for every department to have what they need. So what you have to have is a cost benefit analysis. Now this shows that the benefit of an action should exceed its cost. So let's use the MRI machine as an example. Your radiology department, let's say there's already 4 MRI machines in your radiology department, but your department wants to budget for a 5th machine. Now that 5th machine, I have no clue how much MRI machines cost, but let's just say a nice round number of $50,000. Okay, but you're adding 20% to your able volume. So if I'm going from 4 MRI machines to 5 MRI machines, and let's say I see 5 patients a day on the 4 I have, well, I can add an additional 5 patients a day. Well, the action of purchasing that machine and what I'm going to receive from it as far as revenue is going to outweigh the expense of the machine. So I'm going to get far back more than my $50,000 just by the volume that I can see from that one machine added to my rotation. Now it says once the cost and benefits are identified, a manager must do his or her best to assign monetary values to each cost and benefit. This is easier to do with measurable cost and benefits. When cost and benefits are non-measurable, a manager must estimate as best as they can. Once dollar values are assigned, the cost and benefits are compared. If the value of the benefits exceed the value of the cost, so if I'm bringing in more revenue because of this equipment, then the purchase of the item needs to be examined more closely. Then it's safe to say you should purchase. Now, if the cost is going to exceed the value, that's when you have to examine it more closely. So if I was going to add that MRI machine and I was only going to increase my revenue by $20,000, then it might not be the best purchase at the time if we don't have the money. Now, if I'm going to increase my revenue by $50,000 every year and that MRI machine is going to last for 10 years, then I've spent $50,000 and I'm going to get a whole lot more back. Dropping down to the next to the last paragraph on page 70, it is impossible to predict every change or cost that will affect the HIM department during a given budget cycle. But with ongoing attention to the budget planning process, it is possible to identify likely changes and research costs to therefore present realistic estimates to impact the budget. So again, I'm telling you from experience, it's impossible to know every single thing that's going to affect your budget. And you can look at that in your personal lives as well. You may plan everything down to the T, but let's say you forget that your car tag is due in February. You didn't budget for that. You didn't plan for that. So, again, it's hard to always know every single thing that's going to happen. You can't predict the future. So budgets, we're going to get over into fixed and flexible in the next page. And so you're kind of going to get more of an idea of how they kind of get around some of that. Now, over on the top of 71, it says, despite input from all levels of department management, whether they're just a regular supervisor or they manage a big area in the department, let's talk about coding managers or clinical documentation improvement managers, the final budget is the work of the department head. Because at the end of the day, when that budget is either met or exceeded, that department head is who's on the line. They're responsible for that budget. So I can have 15 people help me sit down and plan our budget for our department. But if I go over my budget by $25,000, $30,000, then that's on me, the department head. So final budget is work of the department head. All right, so let's get into our types of budgets, still on 71. So when creating an operating budget, the HIM department manager needs to know if he or she is working with a fixed or a flexible budget. A fixed budget, also known as a static budget, is based on expected capacity with no consideration for potential variances. So we talked a minute ago about how we would budget for our rent and groceries, and we would budget for all the things that we pay on a monthly basis. Well, that car tag is not something we pay on a monthly basis. It's a once a year expense. It falls in 1 month every year, unless you get a new vehicle at a different time. But a fixed budget doesn't allow for any kind of extraneous things that come up. So this means that your volume projections are made prior to the budget being developed and are used in the budget planning process and are not changed throughout the budget year. If the volume projections turn out to be too high or too low, again, they're not changed. It's fixed, not changing anything. A manager must deal with the budget as it was prepared and respond to volume fluctuations as they occur. So our example here is if a fixed budget, the budget department may project them a number of monthly discharges for the upcoming 12 months. Then the HIM manager compares this projection to historical data, so they can go back in time and look at old census data, and then they can adjust staffing needs for each month accordingly. Staffing needs are then reflected in the annual operating budget as wage and salary expenses. As long as the projected numbers are on target, then the operating budget should be correct each month. But if there's a large fluctuation in the discharges, then the operating budget's not going to be right, and you're going to have a budget variance. So a budget variance is the difference between what you budget, what you plan for, and then the actual amount you spend for that item. So if I plan to spend $500 a month for groceries, and I actually spend $600, then my budgeted amount was $500, but my actual was $600. And so now my variance is going to be $500 minus $600. And again, we're going to look at this on the next page, page 73. But $500 minus $600, which is negative $100, divided by my original budgeted number of $500, and then we're going to multiply that times 100 to get a percentage of how much that variance actually is. So again, we're going to cover that on page 73. Now it says fixed budgets are easier than flexible budgets to create and maintain because again, you set it and you leave it. So we do our volume projections and we don't make any changes. But when we talk about a flexible budget, which is an alternative to your fixed budget, it's based on multiple projected levels of productivity, wherein the actual productivity triggers the levels of resources to be allocated as the year progresses. So in our previous budget example where we had a number of discharges per month, where the fixed budget allocates resources based on that single projection. Let's say we budget 2,000 discharges in the month of January. Well, that 2,000 doesn't change. And we allocate our resources based on that 2,000. Well, in your flexible budget, multiple projections about discharge levels, and then allocate resources based on which projection is most accurate. So I may say, well, we may budget for 1,800, 2,000, and 2,200. And then depending on which one was more in line, that's how my resource allocation goes. Now, flexible budgets are way more time consuming to prepare. And each level of volume must be calculated and planned for. Flexible budgeting does lead to fewer budget variances and allows an organization to respond more efficiently to large fluctuations in volumes. All right, our next type of budget is an activity-based budget. Now, this is used with your capital projects. So, an activity-based budget is based on activities or projects rather than the functions or departments. Because projects can be time consuming and involve more than one department, activity based budgets are often span more than one fiscal year and cross departments. Implementation of an EHR is an example of an activity based budget that it would be appropriate to use one for an EHR implementation. All right, but now moving on to our fourth, our zero-based budgets. Now, a variation on your operating budget is a zero-based budget. Now, a zero-based budget is where each budget cycle poses the opportunity to continue or discontinue services based on available resources so that every department or activity must be justified and prioritized annually to effectively allocate resources. So basically what that means is every year when it's time to start your budget, you start at zero. You don't use any historical data, so you're not looking at previous discharges to get an idea of where you are. But the manager actually starts from scratch. They create their budget based on volume projections and the department's contribution to meet them through review of the department goals and objectives. So every single year, the manager has to justify the need for their department as well as the cost associated with running the department. Now, advantages to this is that it does require an intense review of all the expenses by managers. Okay, so you can't just say, oh, well, we had this in our budget last year, let's go ahead and move it forward this year. And you may not have even spent the money. Sometimes departments will plan for special functions or parties or, things like that. And they may not actually spend that money, but just for our sake, let's go ahead and plan for it this year. But you really may not need it in your budget if you haven't used it in the last 2 years. So every single item, every expense has to be reviewed. Now, on the other hand, zero-based budgets are very time-consuming because, again, you're starting from scratch. And this method tends to reward your short-term thinking managers. So it's kind of a pain to start at zero every year. It's nice to have something to look at and to, kind of guide you. It's almost like recreating the wheel. All right, so let's talk about budget as a controlling tool. So once your fiscal year begins, the budget becomes a controlling tool. So you get a budget report generated each month by the budget department for your HIM managers to review. Now, the format and details included in the budget report are unique to each organization, but common items show the budgeted amount for both revenue and expenses and the actual amounts spent or earned in each budget category. Now, HIM, and we'll talk about this a little bit, but HIM is not a revenue generating department. Okay, so what I mean is they aren't performing a service that actually creates income for the hospital. Now, everybody thinks, oh, well, coding is revenue. Well, you didn't perform the services on the patient that actually brings in the payment to the hospital. You're just part of the revenue cycle where you complete that revenue cycle process so that the hospital gets paid. But you didn't actually perform the function that created the revenue in the first place. So again, revenue is recognized as income earned and the use of appropriated capital from the rendering of services during a period. So again, think about our MRI machine or any other radiology procedures. Any lab test done, they're going to generate revenue. Patients come in for cardiac catheterizations, every meal served, any clinic visits, all the surgeries performed, any consultations that are done, and any other services performed that income is generated from. Those are all revenue items. Now, expenses, again, just like we have monthly expenses, healthcare organizations have monthly expenses as well. Departments have expenses. We talked about a couple of these already, salary and wages. Department supplies. How much copy paper do you purchase every month? Do you need printer toner? Travel. Are you going to meetings for continuing education opportunity, or are you traveling to other facilities to help out? I had travel money budgeted when I was going to each of the community hospitals for North Mississippi Health Services and implementing the document imaging system. So we budgeted $300. I think $300 every 3 months, so that I would have a little bit of mileage reimbursement for driving to these different facilities. Postage is another example. If you do release of information in-house, you have maintenance agreements. 3M, if you use 3M as your encoder, there's a maintenance agreement every year, and it is outrageously expensive. I'm talking about several $100,000 a year. And then contract services. If you have to get additional coding help or you contract transcription, that is an expense every month. So again, it talks about traditionally HIM is not considered a revenue generating area for the healthcare organization. So a lot of times it's hard for HIM to get the things they budget in that bottom up approach, because finance looks at HIM and they're like, well, you don't bring any value, as in revenue, to the organization. So you're dependent on these other departments, these revenue generating departments, to be able to get the things that you need for your department. So it's kind of a sucky situation, but it is what it is. Now, there are some areas within HIM that do generate revenue, but it's not much. So think about release of information. You made more back in the day, because now you can't charge patients more than $6.25 if they come in requesting information. But in the past, state law allowed you to charge $20 for the first 20 pages. Whether it was 1 page or 20, you could legally charge $20. And then it was $1 per page up to 100 pages, and then it dropped to 50 cents a page. Well, there were certain times that we could release records to patients, and sadly enough, you could charge them $300 to $500 depending on how many sheets they wanted printed. And we always work with them. We really don't think you need this, or maybe you just need an abstract and you need these certain documents. No, I want my whole chart. And you tell them, okay, well, it's going to be $1 per page up to 100, and then 50 cents after, and they're like, I don't care, I want my whole chart. Now, you still have attorneys. If attorneys request charts, you can still charge them that fee. So you do generate some income as an HIM department, but again, it's not much. And it talks about, too, if you continue to read at the bottom of 72, is you may also contract out your coding department. So your coding staff may end up coding for another facility or coding for a physician office. But a lot of times that's just moving money from one cost center to another. And when we move over to 73, we talk about a cost center. So a cost center is a group of activities for which costs are specified together for management purposes. So your cost center really represents your department. So the HIM department would have its own cost center number. The radiology department may have several cost center numbers depending on how they break down each section of radiology. So MRI may have its own cost section or cost center, and CT may have its own cost center, and interventional radiology may have its own cost center. Now, for accounting and tracking purposes, anytime a cost is generated, it's recorded in the appropriate cost center. So this is how your budget actually works. You get, you pay for something and it comes out of your cost center. You write your check or you do a purchase order and you put your cost center number down. And so when that bill comes in and it gets paid through accounting, they know who to attribute that expense to, what department or what cost center. All right, so now we're getting into our actual budget variances here. And so what I'm going to try to do is I'm going to try to do some math for you on the screen that you can see. But we're going to actually calculate some budget variances, and we're going to talk about whether those budget variances are positive or negative. So a monthly budget report is the tool that the manager uses to control the financial aspects of the department. Both the budgeted amount and the actual amount spent are shown on the report. So we talked about that, the budgeted amount and the actual amount. The HIM manager reviews each category to determine if there is a budget variance. If the actual amount spent is less than budgeted, then that's a positive variance. If the amount spent is more than budgeted, then that's a negative variance. And so you can see in figure 4.1, we have some math here. So I want to just work this out for you. So give me a second to get this set up, but I'm going to go to notes here so you can see. Now, I wish I could make, okay, let's do that. Okay, so in our example on page 73, we are looking at contract coding services in FY 2019, and then we're looking at what we're going to budget for FY 20. Okay, so what they have here is we spent $250,000 and the cost rose to $300,000 in FY 20. So we would want to calculate the budget variance from one year to the next. So what you do is you take your new number, okay, your new number, which is 300,000. So we have 300,000 here. And then you want to subtract your old number, which was the $250,000. So 250. Okay, and we're going to divide that by our original number of 250,000. That was our FY19 number. Okay, so when we get this, that comes down to 50,000 divided by 250,000. Okay, so 50,000 divided by 250,000 is, and I'm going to use a calculator on my desk to do this, so 50,000, 250,000, that's 0.2, okay, to 0.2, and then just like any other percentage you get, you're going to multiply that times 100, and so now we have a 20% variance, okay. Now, services rose from 250,000 to 300,000 in that 1 year time frame. So that is a 20% increase in coding services. Now, this is a negative variance, okay? So we had budgeted 250,000, but we spent 300,000 the next year, okay? So when you spend more than you budget, that's a negative variance. So negative variances are going to be positive numbers, okay? So positive 20% is a negative variance. All right, so let's look at the next one. All right, so next we have, we're looking at, again, planned and our actual budget, and we're looking at contract coding services was budgeted for $50,000 in March, but the actual cost was only $40,000. Now, we know that our bottom number is $50,000, okay, because that's how much we budgeted. And by our formula on page 73, we put our new number and our original number. This is called our original number, okay, and new number should be on this side, original number on this side. So 50,000 goes here because we budgeted $50,000, so that was our original number, but we only spent 40. So 40,000 goes here, and we do the subtraction. Well, when we subtract 40,000 or 50,000 from 40,000, we get negative 10,000 over our 50,000. And when we do that math, we get negative 0.2. So we're going to multiply that times 100. Now we've got negative 20%. Okay? So a negative variance is positive. I think I said that wrong. I wrote that wrong on the other slide a second ago. But if you have a negative variance, that is positive, because that means you spent less than you budgeted. Make sense? Let's do one more. So let's say that we budgeted $46,000 for microfilm in the month of May. And when we sent our microfilm off, we spent $48,000. Okay? $40,800 minus $46,000, because that's how much we actually budgeted. So now we have $2,800 over $46,000. And so 2,800 divided by 46,000 is 0.06 times 100. When we multiply that times 100, it becomes 6%. And it's a positive 6%. So that is a negative variance, because we spent more than we had budgeted. So when you spend more, again, go to page 73, in that very first paragraph under budget variance. If the actual amount spent is less than budgeted, there is a positive variance. If the actual amount spent is more than the budgeted amount, there is a negative variance. Okay? Now, in the last paragraph, or the last two little paragraphs on that page, it says this means that the cost for coding services from budgeted amount to the actual amount is a negative 20% variance. Note that even though this is a negative number, it is considered to be a positive variance because the actual amount spent is less than what we budgeted. So if your amount is positive, then it is a negative variance. If your amount was negative, then that's a positive variance. Okay? All right, we can come back to that if y'all have any additional questions there. But again, you're looking at the new number minus your original number, and your original number is what you budgeted. All right, moving on over to our last page, page 74, and we're talking about our budget committee. Now, in some organizations, an HIM manager may work with the budget committee. Your budget committee, depending on the philosophy of the organization, is a group of people that has either advisory or delegated authority over the budget process. Now, your chairperson is usually going to be your CFO, or if you have a controller. Your controller is usually in the finance department, and they're typically the director of finance or a VP of finance. Now, the remaining members of the committee are middle management or supervisory personnel from departments throughout the organization. In an advisory capacity, the budget committee acts in the planning stage and makes recommendations to the chief executive officer on capital budget purchases, or provides advice and support to managers as they prepare their budgets. In the controlling stage, a budget committee may also work with the budget department to develop budget policies and procedures for the upcoming year. In some organizations, the Board of Trustees delegates the authority to the budget committee to approve capital requests, prioritize purchases, and review budget variances. Now, an HIM manager may be required to present a cost justification to a budget committee. So a cost justification is a rationale developed to support competing requests for limited resources. So again, we talked about how if there are 50 departments in a hospital, and I'm exaggerating there, but let's say you have 50 departments in the hospital and they all need something this year. Well, they aren't all going to get it. So a budget or a cost justification comes into play here, because these departments then have to come in and say, okay, this is why we need to purchase this, because we're going to gain this much revenue, or we can see this many more patients, or think about it like this. If the radiology department wants a new MRI machine, but the HIM department wants a new scanner so that they can scan charts in more timely, who's going to win? Well, typically your radiology department, even though that MRI machine is exponentially more expensive than a scanner, they're going to win because, again, they are generating revenue. They are bringing money into the hospital through the services they're going to provide with that MRI machine. A new scanner, that's not creating a revenue stream for the hospital. So cost justifications can be written attachments to budgets, or they may be in-person presentations. So you may go before the budget committee and present your case as to why you feel your item needs to be purchased. But regardless of the method of delivery, an HIM manager needs to use their best written or oral communication skills to make their case and successfully defend their budget request. Okay, so good luck and happy studying. You will be doing math on the test for Chapter 4. You will be calculating budget variances. So I would practice these. Again, you have a couple of examples in your book, and I know you've had a couple of examples in your review questions for this chapter. So just know you need to be prepared to calculate budget variances on your test. So again, happy reading and